The following case studies will have progressively more extraordinary stock market crashes that don't have a neat set of criteria like the past few examples that were quite uniform in their neat characteristics. The TSX Composite Index is the benchmark stock index to represent the Canadian stock market, similar to how the Dow Jones Industrial Average represents the American stock market. During the 2014 to 2016 time period that was also examined with the Dow Jones Industrial Average in earlier examples, there is some variation and similarity in the Canadian stock market. There were similar large spikes down towards the end of 2015 because during that time many global stock markets declined quite sharply. However, in the bigger picture for the entire duration, the Canadian markets fell considerably more. And that is in part because the Canadian economy was more resource-based and was noticeably more affected by the declining prices of resources, such as oil. The point of this example is to first reiterate the criteria for a large correction to become a stock market crash, and that is a 20% drop, which has been met here, lasting for at least half a year. And that definitely was the case here as well. The second point of this example is to demonstrate how even stock markets within a particular region, in this case North America, can differ somewhat significantly during the same approximate time period due to the differences between the economies of two different countries. But at the same time, those two stock markets will still exhibit some similarities due to the global connection between stock markets and the global economy. Thirdly, it is also to introduce the idea that the stock market and the economy are not the same. They are certainly connected, but the economy looks towards the present and past mainly, while the stock market is forward-looking into the future. Investors enter the stock market in order to profit from potential growth. The key word here is potential. Investors are under the expectation there will be some growth possibility. Whether that growth comes about is a different story, but the main point is to invest for potential future return. Current and past economic performance are definitely considered. However, they are different, and in some cases very different, to future expectations that have yet to be realized. During a stock market crash, the stock market can lead the economy in the decline because there can be poor future expectations, while the current and past economic performance can be just fine at the current time. Conversely, a stock market can also lead the recovery in that future expectations can be much more optimistic for recovery and growth, whereas current and past economic performance can be quite poor in comparison. And this is in part why it is often agreed that a minimum criteria for a stock market crash is a 20 to 30% drop lasting for at least 6 months. Because part of the definition of recession as an economic term, not a stock market term, is that the economy declines for at least a 6-month period. Additional discrepancy between stock market and economic performance can also come in the form of expectations being less severe than initially expected. For example, economic data can be reported for a country, or an individual company can be reporting its earnings, with the overall expectation being that the results will be bad. However, stock prices can still rise due to optimism for future recovery and growth, because in some cases, the results can be bad, but not as bad as first expected. And this often infuriates investors that tend to focus on the past and present circumstances rather than the future expectations for growth possibilities. Conversely, stock prices can also decline due to a discrepancy of high expectations not being met by some economic data or the results for an individual company. When high expectations are not met, it can often lead to some fear of stagnation and unsustainable growth, which in turn leads to selling and declining stock prices. While at the same time current and past economic performance may still appear quite normal and not bearish at all. The Hang Seng Index is the benchmark index representing the Hong Kong stock market, which is an interesting market that is under the influence of many international forces, which is why it was particularly volatile during this 2018 to 2019 time period. For most of 2018, it shows those classic boundaries between small, medium, and large correction, and it just barely makes the criteria for a stock market crash. However, the question that is less clear is whether the market recovered, because, as usual, it found resistance at those past contentious areas, particularly around the 30,000 boundary, which was the site of the 10% threshold where the temporary support formed during the initial decline. After some more time passes, it becomes clear that the market did not recover, as it declined back to the 26 to 25,000 range, another contentious area that was eventually broken through, and similar to the 2018 rebound, in 2020 the market rebounded but found some major resistance at the now contentious 25 to 26,000 area, acting as major resistance. This chart of the Shanghai Composite Index demonstrates something we saw earlier, where there's a sharp peak due to a very rapid rise, resulting in a very steep decline to begin the stock market crash. With the use of a Fibonacci retracement, it is quite clear that the market hardly even recovered. Instead, it went neutral to slightly downward in subsequent years. And that is why it is important for a market to at least regain 50% of the lost value from a stock market crash before it can even begin to be called a market in recovery. Those past three charts do have some unique circumstances, but overall, they still fit decently well within the categorization of the crashometer. Now let's examine some cases where stock market crash characteristics aren't as clear as those categorizations. The sharp decline due to the Brexit vote in 2016 provides a good example, because the British stock market did affect many global markets, as it resulted in a very sharp decline that was in the boundary of a small correction. However, it is important to note that this event was expected for a long time, and although there was high uncertainty and volatility, the British and many global stock markets recovered from this relatively short-term hiccup. Technically, it does meet the criteria for a small correction. However, it is unique in that it could be called a micro or mini stock market crash because of the rapid acceleration downwards in less than 1 week. The attacks of September 11th, 2001 had a similar effect, but to a larger degree, on the stock market, because unlike Brexit, this was not a scheduled event and was largely unforeseen and unpredictable by the broad masses. Therefore, the short-term downward acceleration lasted slightly longer than the Brexit case, but that being said, in the short to medium term, it was overextended and oversold to the downside due to the rapid reaction. But keeping the bigger picture in mind, it did continue the longer-term downtrend. It was also a much more bearish situation in the bigger picture due to the existing downtrend that had developed following the tech bubble crash of 2000. And during the short to medium term recovery following the initial overreaction to the September 11th attacks, there was natural resistance around the 120 area for this S&P 500 ETF. Despite these very bearish circumstances in the short, medium, and long term, the market did begin to recover later on towards the early stages of 2003. Sure, there was definitely uncertainty, just like the aftermath of any stock market crash, but the market made a gradual recovery due to the fact that The causes of the stock market crash were clear and largely known after they had happened. However, during a flash crash, this is not the case. It is difficult to define what a flash crash is exactly, because it does not fit neatly into the categorizations we have been used to. It isn't usually a full-scale stock market crash in terms of the magnitude of the price drop or the duration it lasts. It is more similar to those events of September 11th and the massive drop for Brexit during that short week. A flash crash can last anywhere from less than 1 day to a bit over a week, and the drop is usually about 10 to 20%. The term flash crash has been around for a long time, however, the term only became very popular after the 2010 flash crash. The crash, simply referred to as the 1987 stock market crash, is somewhere between a flash crash and a traditional stock market crash of at least 20% lasting a duration of about half a year. This is a monthly chart of the Dow Jones Industrial Average. However, despite the unique nature of this 1987 crash, it still exhibits the temporary supporting range following the initial rapid drop, and after this supporting range is broken through, it initiates the second phase with a very rapid decline. Following the crash, there is a relatively stable recovery, and once the market gets back up to the peak before the crash began, there is natural resistance that is eventually overcome as the market rose much higher towards the end of the 20th century. Finally, even a historic event like the Great Depression, stemming from the 1929 stock market crash, does still exhibit the characteristic drop, initially forming a support range, and after this support range is broken through, there is the characteristic rapid decline. That is why it is an important skill to be able to identify key supporting and resisting ranges where high market contention is likely to occur, and that has been useful in unprecedented events such as flash crashes, historic crashes like the 1929 or 2000 crashes, and everything in between, from medium to even small market corrections. The characteristics of supporting and resisting ranges are a very useful tool to have when examining stock market crashes. As we'll see later on, there are many different fundamental factors that can contribute to stock market crashes, and each crash has its own unique set of contributing factors on the fundamental level. However, when looking at the technical aspects of the stock charts, we can see these commonalities that persist through various stock market crashes.